Welcome back to another episode of From the Trenches. This is a show where my colleague James Boyle and myself bring you behind the scenes at Plan First Wealth as we work with clients and we build this business. Hi, James.
How's it going, Richard?
It's going well. It's going really well, thank you. Summer is ending.
Late
back
summer.
to school next week. Yeah, back to school next week. So my routine is about to get completely. I'm going to go from having a very lax routine to a very regimented routine, and my life completely changes when the kids are back at school. So
now, is this a good thing, or do you look forward to this?
Not really. Routine? No.
Yeah.
No.
Yeah.
Not at all. So my summer is ending too.
Yeah.
All right, let's get into this. I'm going to start off this week by telling you about a situation I encountered to see if maybe anyone else recognizes this and help other people avoid making quite common mistakes. And then we'll crack on from there. So I think it was last week now, I met with someone who is on the verge of receiving an inheritance. And this is really common. So even people who have been here for decades and who have essentially cut all ties with the UK in terms of accounts and think that they are completely 100% now domesticated, for want of a better word, and they're not an expatriate, even though they are always an expatriate, but they're not an expatriate, they're a citizen, all that stuff. So they think what we talk about doesn't really apply to them. Still, a lot of these people will at some point receive an inheritance, and this was one such person. And we had a great conversation, really lovely chat. And turns out there's two really common things going on here that he was not aware of. And had he not had a conversation with us, I think could have ended up costing him dearly in the future. The first one, and the most obvious one, is he is going to receive an inheritance from a non-US person. And that inheritance is going to be above $100,000. Now, there's no tax to pay on that in the US, or there's usually no tax to pay on that in the US if they receive it as cash. Tax is dealt with at the estate level in the UK. But any gifts and inheritances from non-US persons have to be reported on Form 3520. And if they're not, the IRS can and will, because they are very hot on this, they will penalise you. And that penalty starts at, I think it's 5% for every month this form is late. And it's literally just one or two lines on this Form 3520, which is normally for trusts, foreign trusts. You have to report that you're getting this inheritance of more than $100,000, and they'll charge you at 5%, which goes up 5% a month for a maximum of, I think, 5 months. Anyway, the maximum is 25%. And you get there pretty quickly, because normally when people realize, they realize like years later, not weeks later. By which point the penalty is 25%, and they are super hot on this.
Yeah. I know you have more to say here, but this is such a common thing that we hear week in, week out, right? Like you said, you might be out of the UK for 20, 25 years. Everything's buttoned up. Maybe all your accounts are even closed. You think of yourself as a US person with US assets. You get an inheritance. Very common, right, for the people we work with. And then equally as common, I would say, is just not realizing that can have specific reporting requirements. And like you say, the penalties can be obscene. I mean, and to your point, this is after potentially inheritance tax has been assessed in the UK, right? So,
yeah. Well, or even, there's a case going through the tax courts at the moment of a Chinese woman who moved here and was given some money by her parents to buy a house and this kind of good stuff. She used TurboTax, which sends a shiver down my spine any time I hear that, associated with an immigrant or an expat. Used TurboTax, had no idea about this form. Later on, reported it on Form 3520 and provided what she believed to be a reasonable court statement, which would hopefully abate penalties. And the IRS have pursued her for it, 25% of the gift from her parents, and it's in court right now.
And she's a student, I think, right? Or she was...
she was I'm not sure, to be honest with you.
Yeah.
I think she was, but I don't want to mix up my cases here. But either way, so even if they win, and I hope they do eventually win, how much money has she spent on legal fees?
And the mental stress, right? The anguish, having to fight the IRS in court. Not a position that anyone wants to be in, certainly.
No. And she wasn't, there was no unpaid tax. And the reason we're bringing this is we encounter this, but a lot of people here are going to receive a gift and or an inheritance from outside the US at some point, and very few people are aware of this filing requirement.
Yep.
And it's such a little thing, but it can have huge consequences down the line. So that was the first thing. You want to bring that to everyone's attention. That pays for itself. You can have a cross-border tax advisor. You can pay a little premium to have a cross-border tax advisor for 10 years, for 15 years. Yes, you're paying a little premium, and it more than pays for itself in that one thing. Right? You're paying for people's. You're not paying for them to fill out the forms, although you obviously are. You're paying for expertise. You're paying for them to know about this form and to head off any problems. That's what you're paying for, and it's worth it.
And the peace of mind, right? Knowing that these kind of landmines, number one, do exist. Many people don't know about them. Doesn't protect them, obviously, if the IRS were to come after you. And number two, knowing that if it does crop up or one of these situations does present themselves, which inevitably it will, some flavor of this, some version of this, knowing that you're in good hands and you have good advice to resolve it when it comes.
And I'm not encouraging anyone to take any action against their tax advisors, but a legitimate defense is I worked with a cross-border tax advisor. That's a much stronger defense than saying I work with TurboTax, because and this is not me making it up. This is actual case law. There's a test that is applied where you have to use if you want to rely on the use of a tax advisor for a reasonable cause, that tax advisor has to be suitably qualified, skilled, experienced in your field. So for us, that means working with a cross-border tax advisor, not TurboTax or Jim around the block, who you're his only expat client. That wouldn't qualify.
Yep.
So it's multiple levels of protection, essentially, I think.
Yep. There's a spectrum, right? And as you know, I know, and probably our audience does by this point, we see every iteration along the spectrum, right? We've seen people self-file and just flat out answer questions incorrectly, right? Or they misread it, or something as simple as, do you have any foreign financial accounts? And they know they do, and they click no. That's kind of one extreme, right?
I knew you were going to bring that up. Yes, folks, we have seen this. We've reviewed tax returns for our clients and for the people we're potentially going to work with, and we have seen this.
Yep. And that's extreme, right? But we do see it. And then there are cases where, and obviously we're talking about TurboTax, really any of these, I don't have to name any other names, but they're all popping up in your head now as we talk, right? Other self-directed tax advice schemes or platforms where they just give bad advice. Literally where they'll have an AI bot or whatever it is, an aside where you click a little question mark and say, do I need to file this? And sometimes they just give flat out incorrect information. And if you're in a position where you don't know what the right answer is, that can be really misleading and dangerous.
Yeah. So the other part of this jigsaw was not only are they receiving an inheritance from a non-US person or estate, part of their inheritance is also going to be in the form of a trust. Or rather, should I say, there is a trust, and the trust, which this is very common for the UK, the asset of a trust is an offshore bond. In conversations with the advisor of this trust to maybe apportion the bond to him, because you can do this. You don't have to surrender the platform. You can apportion segments of it. I'm not going to get into the details here because it's immaterial for our listeners. But essentially, the advisor of this trust is a UK advisor, and he's getting very UK centric advice, which not only isn't helpful to him as a US person, is outright dangerous. Because you know what's inside this bond, right? It's full of PFICs. So the tax treatment of the bond itself is completely different, and then it contains PFICs. This is like double. So the information he's received regarding the taxes is almost the opposite of what it really is for him. And then there's this permanent problem of PFICs. Jeff, we have received your feedback. Passive foreign investment companies.
I was just going to say we've had a very valued listener provide some feedback about we sometimes fall into jargon, so we'll try to be more cognizant of that.
So there are these non-US investments punitively taxed by the US, non-US ETFs, mutual funds, and that would create, first of all, trusts, British trusts and US beneficiaries can be very, very tricky. Then throw in offshore bonds and PFICs, and you've just got a potential unholy mess on your hands. And we had a great conversation. I've directed him to a great tax advisor who's going to help him navigate that. And then maybe on the other side of this, there's stuff for us to do and help as well. And I suspect what I have helped him avoid there is a enormous landmine.
Yeah. And all innocuous, right? I know we keep coming back to this point, but the UK trust advisor didn't have any ill intentions, right? Just isn't well placed to comment on US issues. Inheriting something that they didn't even know was there, right? Or how it was structured, that can cause issues. So these aren't people trying to pull one over on the IRS, right? But the reality is that's not going to protect you if the IRS does come knocking, right? You need to know how to resolve these issues as they come up, these landmines, and they do, right? It is almost inevitable. Being an expat in the States, these things can and will show up.
Well, that's why I've shared this story. I've shared this story because I suspect every single person listening to this episode has either received a gift or inheritance or will receive a gift or inheritance at some point. And I suspect the vast majority will be above $100,000.
Yep.
Some, not all, will have other complications like trusts and property and bonds and PFICs. But I think practically every single person listening to this will be affected by this topic in some way. And hopefully this will help them avoid some of these landmines.
Yep. It's one of those things. I don't know. I'm sure you've experienced this too, Richard. But as we speaking of late summer into fall here, as we go into our portfolio review season, it's one of those things where very often we hear from our clients, people we work with, my parents, or I have an aunt, or someone is aging, right, and they're getting older, and we don't know what's going to happen, but and we are constantly ringing that bell. Doesn't mean you're going to owe tax, but if you do come into inheritance, know that there are reporting requirements if it's above a certain amount. You want to make sure you're working with the right advisor. And
we need to move on from this topic, but we say this all the time, and I wonder how often it lands and how often people just think, oh, that sounds important. Okay, I'll remember that, and then they won't. And we have two sorts of clients. We have clients who work with a cross-border tax advisor, and we know that because we usually connected them and we're involved in that relationship really critically. I don't know if people realize that, but we are. When a client works with a tax advisor who we have a relationship with, we are also involved in that relationship. And I know for these clients, it's going to be taken care of. I don't need to worry about it. And then the other clients who either, very few do it themselves, but the ones that do, or they work with a local person. And I wonder, hopefully we'll be around to catch it that year, but you never know.
I don't want to dwell on this too long, but every once in a while, and we're always open, right? For the people we work with, or if they have tax advisors in place, we're always happy to have a conversation. We can jump on a joint call. We can be CC'd in emails,
we'll work with them.
We can, right? We want to work with them, but there are times, and I know you've seen this, where we get CC'd on an email, we're copied in, and you can just tell that the advice is not complete, right? Or it is just,
100%.
Nothing against a local CPA or someone who's American and US based. They just don't have the first clue about international matters. And there is bad advice that gets shared more often.
And that'll be a warning, people, because there will be people thinking, oh, I've got someone on the corner and they seem they know what they're doing. They don't. If you're saying they seem to know what they're doing and it's a local person who hasn't got expats, they don't. They do, I'm sure, in their regular line of business. But when it comes to you and these additional issues, they don't. Anyway, let's move on. You've got something for us on Roths and do we have to call it this, the one big beautiful act?
I've taken to ABBA, my favorite band name. Let me pull up my notes here. So Roth conversions are a topic that come up fairly often, right? And particularly for our clients.
With good reason.
Yes, it's a powerful strategy when it makes sense. There are circumstances that lead us to believe there are green flags almost, right? When it makes the most sense. But in its sort of most basic form, a Roth conversion is converting a portion of your pre-tax dollars, right? You have dollars or funds in a 401k or a traditional IRA. Those are pre-tax. It's converting them to a Roth account, which is post-tax, and provides tax-free growth. And then upon distribution, those withdrawals are tax-free as well. So it's a form of
not to love about that. Tax-free growth and then tax-free withdrawals. Everyone, this is why we love Roths. Tax-free growth, tax-free withdrawals. Win-win.
Yep. So that's high level, right? Obviously, we've had the ABBA, OBB BA passed in the summer, a lot of which is being worked out, or how it's going to be implemented specifically. Tax brackets aren't changing, right? So we still have 22, 24% where we'd be looking at conversions typically, but there are a couple new items that you have to be aware of. So in particular, probably the biggest headline item here is the senior deduction, right? We have this temporary extra senior deduction for people 65 or older, 6,000 for the year for single, 12,000 for joint. There is a phase out. So keep in mind, when you perform a Roth conversion, you are paying taxes in that year. That counts as income. You want to be extra sure that your analysis on these conversions is now incorporating this senior deduction, right? That's number one. Phase out start at, I think it's 150,000 modified adjusted gross income for the year. So that adds a wrinkle, right? Because now all of a sudden, if that Roth conversion is going to tip you over and start to reduce that senior deduction, maybe the tax savings aren't as attractive. The other piece that we talk about often is IRMA, right? So Medicare premiums, if you go above a certain amount of income, there's a 2-year look back. I believe it's 2 years. That can increase your Medicare premiums, also then potentially defraying some of the benefits of the Roth conversion. Those are the two big ones. In general, if you're someone, and this is a common situation, especially for the audience we work with, right? These people are active, they're traveling, they're doing stuff. They get to 57, 58, 59. They're starting to get the itch, right? Maybe they don't want to be chained to the desk. They don't want to be in the office anymore. They want to go sailing, traveling, whatever those things may be. Very often there is going to be a window there, a golden opportunity, right? Where all these things line up. You have low income because your other sources of income haven't started. Your Social Security, your UK state pension, maybe some private pensions. Those haven't kicked in yet. You're going to have a few, 1, 2, 3, 4, 5 very low income years where this kind of strategy becomes extremely attractive. And if you're not looking at it, you certainly should be. It's something we do for our clients. But even with these new wrinkles from the OBBA, there is still some room here, and arguably there are elements of it that actually make it more attractive, right? So things like extending the lower brackets that were set to sunset next year, those are now extended indefinitely, might give you some more wiggle room to kind of fill up those lower tax brackets. Especially, like I say, if you're in a low income period in retirement and anticipate years of higher income in the future. There's all kinds of downstream effects, right? It's going to decrease your required minimum distributions, RMDs for the jargon heads out there. Those are withdrawals you have to take after your RMD age, usually age 73 for our audience. And again, it gives you this flexibility in retirement. Now you have different tax vehicles. You might have a pre-tax bucket, a post-tax, a taxable brokerage account, and now you have these Roth assets that can help complement, supplement your full income plan in retirement.
Absolutely still reasons to be doing Roths and Roth conversions, especially for early retirees. It's such an opportunity for early retirees to get some of that money out of their IRA into a Roth IRA. But you just got to be really careful, right? You've got to be really careful that you don't inadvertently cause an increase in tax elsewhere, or in the case of IRMA, an increase in premiums. Mm-hmm. And we tend to do this in conjunction with the client's tax advisor, and so just more to be aware of.
One other piece, and this just occurred to me because we have clients in this situation: healthcare subsidies. You want to be careful of as well. So there's phase outs for credits for healthcare. Now, as everyone knows, this is all up in the air at the moment, but those are also something to keep in mind and should be incorporated into your analysis. Something that we look at, right? If you're receiving subsidies for health coverage, you very likely don't want to jeopardize that for Roth conversions.
Gosh, there are numerous tripwires, aren't there? Then there's
a lot of moving pieces.
Senior deduction. There's the IRMA thing to take into account, and IRMA can add some real money to your annual Medicare. If those who don't know what we're talking about, IRMA is your premium for Medicare, and the more income you make, the higher your premium. And we're talking like real money here.
Mm-hmm.
And if you have a huge hit on your income because of Roth conversion, that can have a significant impact when you come to do your when you start receiving these premium invoices. So
Yeah.
yeah, lots to take, lots to be aware of. Okay, we have some listeners' questions. We're gonna hit really quickly, right? Really
Hmm.
quickly because we're running out of time
Hmm.
here. Look, I'll take the first one. We have received more. So if anyone's listening to this thinking, "Oh, that's not my question," we're gonna hit some of these over several episodes. But one of the questions I got was about someone, an expat, dual citizen, sending their dual citizen child to college in the UK, to university, I should say, in the UK. What tax reporting requirements are there? So I'm not going to spend a lot of time here because really the answer is everything you would, all the same reporting requirements still apply. There's no, yeah, I think if I remember rightly, in the UK, if you are a student, I don't know if this is still the case, but if you're a student, you're not even taxed. So you're really not thinking about tax or reporting. But yes, as a US citizen, if you go to the UK as a student, everything applies. So if you have earned income, or if you have interest income above a very low threshold, it's like $1,250 unearned income. You have to submit a tax return. So if you have a job that's paying over that, even in the UK, I think you'll have to submit a US tax return. I don't think you have to pay tax because you'll be able to call on an exclusion, but I think you have to submit a tax return. And then there's all the same FBAR and FATCA reporting requirements. So if they have a UK account, which I'm sure they do, and at any point, the combined value is more than $10,000, then all those accounts are reportable on the FBAR. At FATCA, which would have an 8938 requirement for these foreign accounts, foreign assets, it's much higher. I think it's $200,000 or $300,000 at any point in the year, so it's much higher. But there are all the same requirements. Now, I think there might be some differences if you claim them as dependent on your tax return. But bottom line, there's no different as if I was going back to work in the UK. All the same.
Yeah. No. Maybe put a little bit differently, but saying the same thing. There's no special protection if you're an American student abroad, right? You're still really. Yeah. You're still under, it's your responsibility to file the same way you would if you went over to work or you were someone else.
And this is less of a thing in the UK, although I guess maybe if someone was like is it a Fulbright scholar or do they come here? Or a Rhodes scholar, maybe?
Rhodes scholar, yeah.
A Rhodes scholar. I think Fulbright comes here, Rhodes goes there.
I ever knew that.
Scholarships.
It's good to know.
Some scholarships are taxable in the US.
Yes.
I think maybe tuition isn't, but if it goes towards board and food, then it is. Yep. So you need to look into that as well if you are a lucky recipient of such an award.
That's a good point. Yep.
We can do more on this. So if this is something people want us to expand upon, rather than my hastily put together thoughts, then let us know. We'll do more. But if that suffices, then good luck to you.
We'll have to. This is a peek behind the curtain. We'll have to come up with some kind of fun cross-border pun, like mailbag flavored, of the questions that come in. Because we want, obviously, if anyone's listening, don't be shy. Send them in. We also had another longtime listener, and these are questions we get fairly often about healthcare, essentially, and mostly focused on if you're a U.S. person leaving the U.S., maybe you're a British expat who has citizenship now and heading back to the U.K. A lot of different nuance here, but just to cover off some of the top line questions here, Medicare. Right. So for anyone listening, a lot of our audience, I'm sure, is familiar. Once you reach age 65, assuming you've paid enough into Social Security system, you'll be covered under Medicare as a retirement healthcare coverage, almost entirely limited to the U.S. Right. So do not think that a Medicare plan is going to help you if you do relocate back to the U.K. Approach it as if it's U.S. only, because that pretty much is the truth. There are some Medicare,
and also people also. If you're leaving the US on holiday, vacation, you're returning to the UK, even if you're going for the summer or ever, you need travel insurance.
Yep.
The amount of people who travel without travel. Yes, we have insurance for healthcare in America, but if you're in Mexico or Canada or the UK or anywhere, they're not going to respect your Kaiser Permanente or sick or whatever it is. It's just not a thing. You need travel insurance.
Yep, absolutely. The other piece here, thinking of the UK. So, to what extent will the NHS help, right, or provide coverage for an American? So, the important thing to think about for the NHS is based on residency. So, if you're a UK resident, you should be covered. Emergency care is free for anyone. If you're
Doesn't mean having a
traveling,
house there and spending the summer there. That
correct, you
means
have to
being
be
a
living.
tax resident. You have to be living there, which means you're paying
Yep.
taxes there, which means, that's not, oh, I have a house and I spend summer there. That's not a resident.
Yep, exactly. And if you're an American who's moved over, there actually is. This was news to me doing the research here. There is an immigration health surcharge. It's very affordable, right? Especially when you think about U.S. healthcare coverage. I think currently it's about £1,000 per year for adults. But you may, if you don't have that residency, as you just mentioned, Richard, you may have to pay that surcharge. That will then give you full access to the NHS.
So if I moved back, would I have to pay that? I wonder.
Based on the research I've done, I think if you become a UK resident and you'd be a UK person, obviously at that stage, you would get access to the NHS.
Mm-hmm. So who would have to do the surcharge?
My assumption is if it's a temporary thing. So this article that I'm sourcing here is mentioning students, for example, going back to the student piece, temporary workers, that kind of thing. Travel insurance, we just talked about. So like if you're just visiting, consider travel insurance. Same thing here, as a Brit returning to the UK entitled to NHS. They asked about national insurance contributions. Again, NHS is based purely on residency, not on national insurance history. There's a number of items here. So ACA, the Affordable Care Act, going back to our American plans, going to cover in the UK or Europe? No. Essentially, flatline, assume no. Talked about travel insurance. EU countries, we've gotten some questions about moving to the EU as that becomes more popular, grows in popularity. Each of those are going to have their own system, right, and rules. So you have to do research. It's France, Spain, what kind of coverage you can look at. Those were the main the highlights.
Not just on health, right? So you got to be careful. So if you go back to talking about Roths, you move to the UK, great, Roths are respected. If you move to France, then I don't think they are, or maybe France does, but others don't. If you have a trust and you move to the UK, you're probably going to be fine. If you have a trust and you move to France, you could be in real trouble. It is totally different. Like everything is totally different everywhere you go, and to assume it's the same is very, very dangerous.
Yeah. Those are areas where you definitely want. We actually had a call recently about a trust, right? And that was the example given. You have a trust and you go to France, you want to be really, really careful because there is a very high chance of taxation there that probably could be avoided, taking the right advice.
Yeah, but also if you go to France, retirement accounts, IRAs are beneficially taxed versus other countries. Okay. So it really is swings and roundabouts. You've just got to know. You've got to find people who can help you navigate this. You really do. Mm-hmm. Okay. Right. Should we just very quickly talk on the last episode? I had Virginia Latoya Yeager on again. She is fantastic. She is our resident international tax attorney. And she came back on to talk about statute limitations and tax returns and how there's usually a 3 or 6 year statute limitations, which is great, which gives the IRS 3 or 6 years to come after you for your tax, for inconsistencies or problems with your tax return. However, when a tax return is incomplete, and incomplete includes missing forms, so you might be submitted a 1040 tax return, but if any of the international forms that we so frequently talk about and deal with in this business and on this podcast, the 8639s, the 3520s, the 8621s, I'll just keep lobbing numbers at you. But any of these forms that are related to trusts, pensions, PFICs, investments, which in our experience are so frequently missing.
So common.
This means your tax return is not complete, and therefore the statute of limitations is not ticking, which means the IRS can come after you on problems with it indefinitely. And apparently they do this. And Virginia came on with receipts on times when they are doing, and they are going back decades in some cases. It's wild.
And I don't want to don't want to paraphrase Virginia. For the specifics, go ahead and go listen to that most recent episode because it was so illuminating, something that we encounter very often. But I found it interesting, this idea that, because on the surface it almost sounds, I mean, it sounds mean spirited, right? It sounds like that's not fair.
Yeah.
Their view is that since it's an incomplete return, the statute of limitations essentially never starts, which makes a strange sense of logic, right? When you think about it, it's almost like we never finished that return. So how could the statute of limitations have started? The countdown didn't even begin. 8938, you mentioned 8621s, all these forms that so commonly we find that taxpayers are deficient in, right, or are missing, or weren't aware of. Know that leaves that statute of limitation open. And then another really important point I know that you underlined in that episode, Richard, is it's not a narrow focus on just that missing form or just that piece that wasn't filed. That leaves your entire return open for audit, for reassessment, for penalties. I mean, this is a major issue, and unfortunately, it's something we see fairly frequently.
Yeah. So go and give that a listen, folks. Just again, the more you know about this stuff, well, first of all, you'll go through it's like the 5 stages of grief. You'll be in disbelief and not deception? What's where you kind of deceive yourself? What's the word I'm looking for?
Yeah, rejection, is it? Or denial?
No, denial. You're in denial. Then comes acceptance, and I promise you, I've been through all those stages. But the more you know, the better armed you are, the better equipped you'll be. If there are any issues, you can resolve them. Usually, you can voluntarily resolve this stuff and move forward, more confident and without these threats hanging over you. Frankly,
yeah.
Right, pick a mix. Well, you got anything good for us this week?
Pick and mix. I was going to speak about a book, which I can mention, but I watched a fascinating documentary the other night called Behind the Curve. And it is a look at, this feels a little quaint now, 7 years, 7 years on. It is a look at the movement, call it, of people who genuinely and truly believed the earth is flat. That the earth is not a globe. Yeah. Now, this documentary, I think it's on Amazon Prime right now. Thankfully, it wasn't like piling on these people and making fun and look at how ridiculous it is. Partially, I guess, very entertaining, but also a look at the psychology behind this kind of, call it cult-like thinking or rejection of material facts. I'll give you one kind of teaser of something that happens. So they're following this group that performs, in their mind, scientific experiments, right? To try to determine the veracity of their claims. The earth is flat, is a disc. And they buy this, and I'll forget the term, $20,000. They invest into this gyroscope is effectively what it is, right? It's something that as the earth spins, it will show you, for example, 15 degrees of movement in an hour. They do all this work to get that set up. They have it all ready to go. They're going to do the experiment. They do the experiment. 1 hour passes, 15 degrees as per the rotation of the earth. And looking dead down the barrel of the camera, the gentleman who's running this experiment goes, that doesn't make any sense. But we're going to have to keep doing this until we get the results we want. And there's not a shred of irony, right? There's no self-awareness at all. It is the purest form of confirmation bias. We talk about this when it comes to behavioral finance and economics. The purest, most undistilled form of confirmation bias that I've ever seen. Frustrating in parts, fascinating. But if you get a chance to watch it, it's called Behind the Curve. Yeah.
Okay, I'm going to have to. That sounds really... So, I'm interested. Are most of them American?
Yes, it is. Right. Not all of them, but it's based in America. They do these conferences and things that are like in Arizona.
Okay. I'm going to check that out. And my recommendation, or my recommendation for Pick and Mix is a client recommended a history podcast to me, and I'm devouring it. I can't get enough of it. It's called The Rest is History, and it's by a couple of British historians, Tom Holland and James Sambrook, maybe, I think. It's just two good friends who have got a wealth of knowledge and a wicked sense of humor. If you like British humor and you like history, you will love this podcast, and
I
I
had to check it
love
out.
this podcast. So I'm a huge fan of Dan Snow's history, as people may be aware. They tend to be single episodes, sometimes solo, often with a guest. These tend to be like series. So I've just listened to a series on the First Punic War, and then the Second Punic War, Hannibal, Rome. So they'll go a bit deeper, but it's also about the banter these two have between them. It's just wonderful. And I if anyone's on the fence, very recently, the last 2-3 weeks, they've released a 2-part series on the assassination of Abraham Lincoln, which ties with the book I'm reading right now. So I wanted to read it. I wanted to listen to it, and my God, it is not only is it interesting, but it is so funny. Like, especially the second one. They are cracking themselves up about silly American names. There's Thurlow Weed, and I think there's a guy called Peanut Barnes, and they are just in hysterics about silly American names.
And that's fertile ground there.
I'm walking down the street laughing out loud. I have people looking at me. I've got one point I'm in the kitchen listening to it. My kid's like, "Dada, what's wrong?" It's laugh out loud funny listening to them crack themselves up about silly American names, and then they're obviously they start banging on conspiracy theories, and because apparently they did a series on JFK, and a lot of American listeners reached out to them and said they were too dismissive about the conspiracy theorists. They didn't take them seriously enough. So then they're just like ripping apart conspiracy theories and Americans having these silly ideas, and it's interesting. And I think I actually cried laughing at one point. So I highly recommend people go and check that out. You will not regret it.
Yeah, that sounds good. There's something about taking something that is historical and educational, and then just them having a blast helps a lot.
Oh, it was great. All right, I think that's all done this week. Then, James, good to see you again. And till next time.
Yes, like and follow wherever you listen to podcasts. You can find us at our emails, james@planfirstwealth.com, richard@planfirstwealth.com. Give us a review, 5 stars if you can, if you're enjoying the content, and we'll be back to you shortly.
And send us your questions. We will answer them.
Yes, we're listening. That's for sure.
All right. Thank you.
Thanks.
Ciao.
All. Take care.